If you're trying to get rich with less than $20,000 in your account, you are literally playing a rigged game. Here is why your brain is currently sabotaging your wealth and the exact threshold you must hit to break free. Here's the brutal truth about money that nobody wants to tell you. That number everyone's chasing, $1 million, 10 million, that's not where the magic happens. The real turning point? The moment everything actually changes in your life? It's $20,000. I know what you're thinking. 20 grand? That's it? But stick with me here, because what I'm about to explain will completely shift how you think about personal finance and building wealth. Warren Buffett himself said, the first 100,000 is the hardest. But in today's economy, for most working people, the real psychological threshold, the point where your entire relationship with money transforms, is $20,000. And here's why that matters to you. Let me paint you a picture of what life looks like below this threshold. When you've got less than 20,000 in savings, you're not actually building wealth. You're fighting for survival. Every single day. Behavioral economics research shows us something fascinating. When people are stressed about money, their cognitive bandwidth gets hijacked. There's literally less mental capacity available for making smart decisions. It's called scarcity mindset, and it's costing you way more than you realize. Think about it this way. Your car breaks down, $500 repair bill. If you've only got $1,000 saved, that's not just an expense. That's a catastrophe. You might miss rent. You might have to take out a payday loan at insane interest rates. And once you're in that cycle, man, it's like quicksand. The poverty trap is real, and it works like this. When you have no money, the cost of existing in this world is actually higher. Banks charge you fees because your balance is too low. Landlords hit you with late penalties. You buy cheap shoes every year because you can't afford quality ones that last. This is what I call financial fragility. And the scary part? Studies in behavioral economics show that chronic financial stress actually lowers your effective IQ by 13 to 14 points. That's worse than pulling an all-nighter. You're not making bad decisions because you're stupid. You're making bad decisions because your brain is in constant survival mode. But here's where it gets interesting. The moment you cross that $20,000 line, and I mean the exact moment, something magical happens in your psychology. You gain what I call refusal power. Let me explain with a scenario. Two people sitting in the same office, same salary, same skills. The only difference? Jack has zero savings, maybe even credit card debt. Mike has $20,000 in the bank. Boss walks in with an unreasonable demand, work the weekend for free, promote a defective product, something that crosses the line. What does Jack do? His heart rate spikes. Cortisol floods his system. His brain screams, if I say no, I might get fired. If I get fired, I can't pay rent next week. Fear hijacks his rationality. He says yes, even though every fiber of his being wants to say no. Now look at Mike. Mike's got $20,000. That's 6 months to a year of runway. When that same unreasonable demand comes, his brain stays calm. He can evaluate the situation rationally. He can look his boss in the eye and say, I don't think that's appropriate. Let's find another solution. Or if it really crosses the line, he can walk away completely. See, Mike didn't actually quit, but because he has the ability to walk away, he holds all the power at the negotiation table. That's the invisible dividend of that first $20,000. It's not about buying stuff, it's about buying back your dignity and your rationality. Warren Buffett always says, if you can't walk away, you can't negotiate. That 20 grand, that's your negotiating leverage in life, and this applies to everything. Toxic relationships, bad business deals, jobs that drain your soul. When you've got that financial cushion, you're not making decisions from desperation anymore. You're making them from strategy. Now let's talk about the math, because this is where compound interest starts to matter. Einstein called compound interest the eighth wonder of the world. But here's what most people miss. Compounding requires critical mass. It's like a nuclear reaction. If you don't have enough uranium, the reaction simply won't happen. In wealth building, $20,000 is that critical mass. Let me show you why. Say you're a genius investor. 10% returns every year, which is actually incredible, by the way. Most professionals can't do this consistently. If you've only got $1,000, a 10% return gives you $100. That's a nice dinner, maybe 2 tanks of gas. Then it's gone. It doesn't structurally change anything about your life. But $20,000 at 10%? That's $2,000 a year. For many families, that's a full month's salary, 2 months of rent, a car payment covered automatically. This is the difference between noise and signal. When your investment returns can cover a major life expense, rent, car payment, insurance, you've gained an invisible partner. This partner doesn't sleep, doesn't eat, doesn't complain, but every single year, It faithfully earns back a month of freedom for you. Warren Buffett has this famous analogy. Life is like rolling a snowball. The important thing is finding wet snow and a really long hill. That $20,000, that's the first tight core you've packed together. Without this core, you can scatter snow all over the hill, but it'll just blow away. It'll never gather momentum. Let's watch this snowball roll down the hill of time. There's a simple tool called the Rule of 72. Divide 72 by your annual return rate, and that tells you how long it takes your money to double. At 7 to 10% annual returns, which is standard for index funds tracking the S&P 500, your money doubles every 7 to 10 years. 20,000 becomes 40, 40 becomes 80, 80 becomes 160, 160 becomes 320. And here's the kicker, you don't even need to add another penny during this process as long as you don't touch it. As long as you let it roll down that long hill, by the time you retire, this initially insignificant 20,000 could become a massive sum. This is why before you save $20,000, you shouldn't obsess over rate of return. So many young people have $3,000 and they're chasing cryptocurrency, options trading, meme stocks. Why? Because they feel like 10% isn't enough. They want 500% returns. That's suicidal logic. Because you're focusing on the wrong thing, you take insane risks and you lose everything. Back to square one. Listen carefully. Before 20,000, your job is defense. Accumulation, protection of capital. You're squirreling away acorns like your life depends on it, because it does. This is pure physics. There are no shortcuts. You pack that wet snow tight through selling your labor and living below your means. But once you've built that core and placed it on the slope, gravity changes. Before, gravity was pulling you down. Now, it's pushing you forward. This is the shift from human-driven wealth to capital-driven wealth. Before this line, you work for money. After this line, money starts working for you. But here's where most people fail. This is the dark part nobody talks about. I call it the great filter. Statistics show that many people actually save $20,000 at some point in their lives. Some people do it multiple times. But the vast majority end up broke anyway. Why? Because they can't resist the reward trap. You work 3 years, eating ramen, skipping vacations, saying no to friends, you finally hit 20,000, and your brain goes haywire. It screams, "You've worked so hard, you deserve a reward, you're rich now." And coincidentally, right at that moment, your 10-year-old car breaks down again. You walk past a dealership, brand new SUV, down payment, exactly 20,000. The devil on your shoulder whispers, "You can afford this, you've earned it." This is the moment the filter activates. Most people fall right here. They sign the papers, drive that shiny car home, and they feel like winners. But what actually happened? They just killed the golden goose before it could lay eggs. That car isn't an asset, it's a liability. The second you drive off the lot, it loses 20% of its value. Even worse, you didn't just go back to zero. You took on a car loan, higher insurance, higher gas costs. The gravity well opens up and sucks you back in. And this time, because you tasted that new car smell, you can't go back to being frugal. You might never get another shot in your lifetime. There's also external pressure. Sociologists call it the crab bucket effect. Put one crab in a bucket, it climbs out. Put multiple crabs in, whenever one tries to escape, the others drag it back down. When you save 20,000, when you start refusing meaningless consumption, when you talk about investing instead of gossip, people around you get uncomfortable. Your friends, co-workers, even family will say, "What's the point of saving? Money's meant to be spent." They mock you, not because you're wrong, but because your discipline highlights their lack of it. Subconsciously, they don't want you to pass through that filter because it means you're entering a world they can't reach. To pass this filter, you have to get comfortable being a little weird. You have to enjoy watching your bank account grow more than watching your closet fill up. Warren Buffett and Charlie Munger lived with these misunderstandings their entire lives. They drove ordinary cars, lived in modest homes, ate hamburgers. People thought they didn't know how to enjoy life. But what those people didn't understand, they were enjoying something way more valuable. The sound of the compound interest machine humming day and night. So, when you save that 20,000 when it feels hot in your pocket, begging to be spent, you have to resist. Tell yourself, this money isn't for rewarding my past, it's for purchasing my future. This is my seed. If I grind my seed into flour and eat it today, I'll never see a harvest. This is the greatest test on the road to financial freedom. Not a test of earning ability, but a test of worthiness. Do you believe you deserve long-term freedom or only short-term pleasure? If you can resist that car, resist that vacation, resist the crabs pulling you down, congratulations. You've just joined the top 5%. Okay, so you've passed the filter. Your 20,000 is still intact. Now what? This is the tactical phase, the blueprint from 20 to 100,000. People always ask, Warren, which stock should I buy? Which hot trend should I chase? My answer is boring but bulletproof. If you try to gamble this 20,000 on the next moonshot, you've already lost. At this stage, you don't gamble, you position. We're going to carve this seed capital into two parts, the bulletproof vest and the soldiers. First, take 5 to 10,000 and put it in a high-yield savings account or ultra-safe government bonds. This is your bulletproof vest, absolutely untouchable. It's not for investing, it's for buying peace of mind. When your car breaks down, when you get sick, when life throws curveballs, this money rushes to the front lines and blocks the bullets. Only when you have this armor can you hold steady on the investment battlefield. So many people lose money in the market not because the market's bad, but because they had no emergency fund. The market crashes 30%. They suddenly need cash. They're forced to sell at the absolute bottom. That's the dumbest way to die financially. So rule 1, first 10,000 stays liquid. The remaining 10 to 15,000? Those are your soldiers. For ordinary people with no insider info and no Wall Street connections, I've got one recommendation. Don't try to find the needle in the haystack. Buy the entire haystack, index funds, low cost, tracking the S&P 500 or total market. Send your soldiers out to occupy the economic territory of the entire country. You don't need to study charts. You don't need hot tips. You just let them sit there and harvest dividends from the entire economy's growth. As long as humanity progresses, this portion slowly inflates over time. But that's not enough, just letting 20,000 compound in the market. You'll get rich. But it's slow. You need a turbocharger. This brings me to asymmetric risk. When you're broke, you can't afford any risk. But when you've got 20,000 as a cushion, you're qualified to play a different game. Asymmetric risk means limited downside, unlimited upside. Best example, investing in yourself. Take $1,000. Don't gamble it in crypto. Use it to learn a skill, earn a certification. Take a course that increases your earning power. Worst case, you lose $1,000 in some time. That's your limited downside. Best case, that skill bumps your salary $500 a month. That's $6,000 a year. $60,000 over 10 years. Invest $1,000, return $60,000. No legal stock market play offers that kind of return. But in human capital, it's the norm. What did that 20,000 give you? A buffer where you won't starve even if you fail. You can try a side hustle. Do trial and error. Find a second income stream. This is the fundamental difference between the poor and the middle class. Poor people lacking a buffer can only sell cheap labor day after day. You've got runway. You can spend money to purchase future earning power. At this stage, your goal is sprinting to 100,000 as fast as possible. Charlie Munger said the first 100,000 is the hardest, but going from 20 to 100 is way easier than 0 to 20, because now you've got dual engines. One is the compound interest machine in the market, small but spinning. The other is active income from your self-investment. Before we move on, let me give you the death list. 3 pits that will instantly bring you back to 0. 1. Never use leverage. Never borrow money to invest. Banks will happily lend you money because you've got 20,000. Don't listen. Leverage removes your time advantage. 1 bad fluctuation and you're liquidated. 2. Don't touch complex derivatives you don't understand. Options, futures, high-frequency trading, those are slaughterhouses for professionals. You're walking in as a lamb. 3. Don't buy a house at this stage. I know it sounds counterintuitive, but 20,000 is too thin for a down payment. Buy a house now, you'll be drowning in mortgage payments. Your cash flow locks up. That refusal power you just gained, that freedom to say no, it vanishes instantly. You become a slave to the bank again, afraid to quit, afraid to take risks. Be patient. 100,000 is the next milestone. When you reach it, the compound interest machine will be roaring so loud you can't ignore it. By then, you're not rolling a snowball anymore. You're triggering an avalanche. But right now, put on your vest, deploy your soldiers, and increase your own value. Final chapter. This isn't about the number in your bank account. It's about your quality of life as a human being. When you save 20,000, you might feel disappointed. You look in the mirror, you look exactly the same. No Rolex, no sports car, same old clothes. But here's the invisible dividend most people overlook. This money is paying you in something called a low cortisol life. Cortisol is the stress hormone. When you have no money, when rent is always a question mark, cortisol stays elevated. It's quietly poisoning your body, causes insomnia, makes you anxious, crashes your immune system, ruins your relationships. The stress of poverty is literally a chronic disease. But when you've got that $20,000 safety net, even though you haven't bought a single thing, your cortisol drops. You sleep better. You're more patient with your kids. You argue less with your spouse about money. This invisible health dividend is worth more than the 20,000 itself. Warren Buffett always says, money can't buy happiness, but it can buy away a lot of unhappiness. That first 20,000 buys away the nightmares that wake you up at 3 a.m. People think Buffett's happy because he's worth billions. Wrong. Even if he only had 20,000, he'd still be happy. Because 20,000 is enough to buy his favorite burgers, live in a warm house, and most importantly, do work he loves. This brings me to the final piece of wisdom. Don't let money become your master. Before 20,000, money is your master. You obey it. You do jobs you hate. You tolerate bosses you can't stand. But after 20,000, the relationship flips. You become the master. Money becomes the tool. If you save this money just so one day you can splurge like crazy, you'll never be truly wealthy. You're just a poor person holding cash. But if you save this money to win control over your own time, even with only 20,000 in your account, you're a wealthy person. All right, let's look back at how far we've come. We started in that dark gravity well, talked about how brutal and fragile life is below 20,000. We covered the psychological shift, how that number gives you refusal power to say no in this harsh world. We broke down the compound interest machine and how that core of wet snow begins rolling downhill. We discussed the great filter, why you must resist consumerism and not kill your golden goose. And finally, we gave you the blueprint. Put on your bulletproof vest, deploy your soldiers, conquer that first 100,000. All of this, the fulcrum that can shift your entire destiny, is just $20,000. It sounds small, but to those who understand it carries the weight of a mountain. If you haven't reached this number yet, don't lose heart. Ignore the wealth flexing on social media. That's noise. Focus on your own feet. I don't want this video to be entertainment you watch and forget. I want to issue a challenge. If you're serious, if you truly want to climb out of that gravity well, drop a comment right now. Tell me your current status. What are you willing to sacrifice to save this 20,000? Maybe it's giving up your daily coffee. Maybe it's not buying new shoes. Maybe it's starting a side hustle. Write it down. This isn't a contract with me. It's a contract with your future self. When you actually save that 20,000, whether it takes 3 years or 5, come back to this video. Reply to yourself, I did it. By then, you won't have just changed your savings. You'll have changed the trajectory of your entire family's destiny. The game starts now. Go win your first round.